Greetings guys, I welcome you in this wonderful video, and we are going to be sharing about trading breakout when it comes to volatility 75 index or any other asset. So it is not only limited to that, but I'm just making this video specifically for volatility 75. So what you need to understand, firstly, for you to trade breakouts, you need to know that usually breakouts, when they happen when there is a pattern that is already formed, or whereby the market is flowing in a certain manner, and all of a sudden that pattern is disturbed, or it is being broken. So when it is broken or breached, that's what we call a breakout. So breakouts, those are things that we cannot avoid. They happen now and then in the market. And what you need to know, and the most common place where breakouts usually happen, it is when it comes to ranging markets. When it comes to ranges, that's where usually breakouts happen. Why? It is because when the market shifts from moving into an uptrend going into a downtrend, it shifts through a range. Usually that's what happened. The market goes up, it enters in a range, and it goes down. It enters in a range, it goes up. Same thing applies, it goes down, and again before it goes up, it shifts again. So why does this thing happen? You need to understand that the market, it is driven by strength. It is strength driven. So when it comes to strength, when strength decreases, that's where we'll see the trend shifting into a range. That's a decrease of strength. Same thing when strength comes back again, we'll see the same range becoming a trend. So it's a matter of strength. The market is a matter of strength. So for you to understand trading breakouts, the reason I'm putting this out, it is to understand that our goal as traders, it is to make sure that we get let me make an example of this downtrend here. Our goal as traders, it is to make sure that we get this downtrend while the market is still on top here. Or when I can come to a chart, we get this move while the market is still on this area. So our role, it is not just to sell down here, but when we sell down here, we are adding to positions. So we should be selling up there for us to make money. And when we buy down here. Same thing applies, we sell up there. So that's our role, and that's what we should do as traders. We sell high and we buy low so that we'll be profitable. So now, for you to get these entries, for you to get these early entries, you need to understand how the market shifts from the range to the new trend. You need to understand this. How does it shift from this range to the new trend? Because our role, it is to make sure that we enter on top somewhere here before the market can go down. It should go down while we are still in the trade. So one thing that usually happen when it comes to these currency, when it comes to this pair, volatility index, it usually happens that the breakout can be predicted. It can be predicted. It is easily predictable. So I will give you two things. Usually, you need to understand one thing: how the market enters the range. That's what you need to understand, how the market enters the range. So let me make an example. Let's say the market enters the range while it is still strong. Let's say it enters the range while it is still strong. Let me just make an illustration here. Okay, let's use this one. So you can see that the market was moving strongly upward here, and all of a sudden strength decreases in this level until it moved in a straight manner up there. So you can see that now the market, it entered this range with strength going down. It entered with strength going down, meaning you can see that this range is not a surprise. This range is not a surprise. It was supposed to come. Why? Because we have seen, starting from here, we have seen sellers coming in, and here they came in more powerfully, and here they came in all the way. They crashed their previous low to this low here. So we can see that here already now the buyers were no longer active as they were before right here. So you can see that here already we're expecting two things. We're expecting the range, and we're also expecting a reversal. So fortunately the range took place, so that's what we were expecting. So if we're expecting a range or a reversal, when the range happens, we know that the reversal is coming next. So now once we've seen this, that the market, it enters the range with very low strength, now we know that a reversal is bound or likely to happen on the downside, or a breakout is likely to happen on the opposite side, on the downside. Why? Because the buyers were decreasing in strength. So if they were decreasing in strength, we are likely going to see the market collapsing all the way, going down. So now as a trader, when you try to understand a breakout, that's the first thing that you need to look, how the market entered that zone, how the market approached that zone. Then in that way, you're going to understand that the breakout is going to happen on which side. For an example, let's say the market was moving in an uptrend, and all of a sudden it just enters in a range quickly like this. That's where we don't crown this as a range, we crown this as a corrective, but a corrective which is horizontal. So it is a horizontal corrective, and the market is going to collapse and continue with its initial move. Why? Because it entered this phase while it was still active in strength. But when it entered this phase, like let's say it pushes up and then it begins to slow down, and then boom, it enters in a range. So we know that it enters this phase already, the bars were getting weak, so it is likely that this can be a reversal. So I hope we understand that. So the second thing that you need to understand now inside the range, it is to understand how the waves are being formed, the formation of the waves, or the behavior of the waves. How are they behaving? How are they formed? For an example, that's where you're going to observe things like these, highs like this, whereby now they are no longer higher than the previous one, which means once you see this, now you have an assurance that my breakout is going to happen on the downside. Because when we are in a range, we are looking for a breakout. It's either the breakout is going up or the breakout is going down. So once you see something like this in the waves, that okay, I have a high which is lower than the previous one, so it shows that now your sellers, they are more stronger than the buyers. It shows that your sellers are more stronger than the buyers, so the buyers are weak, although the breakout haven't happened yet. But you know that now my buyers are weak, so if the breakout is to happen, it shall happen on the downside. So then that's where you wait for your last high, where you will sell, meaning when you see this high, that's where you sell even before the breakout happens, because we don't want to sell here, we want to sell before. So this is a simple way to understand how to get the trades before the actual moves happen, so that when the moves happen, you are already in the market and you are profitable. So I hope it is making sense. So thank you for watching this video. That's it for today. I'm still going to share more of the information. Remember to like, share, and subscribe. Thank you.